Welcome to this session on development financial institutions in India. In this module, we'll trace their evolution, understand their objectives, explore their role in shaping the economy, and study key institutions like IFCI, ICICI, and IDBI. Commercial banks mainly deal with short-term deposits and working capital loans. But India needed long-term finance for infrastructure and industrial growth. That's where DFIs, or development banks, stepped in, providing the backbone for capital formation. The journey began in 1948 with IFCI, followed by state financial corporations in 1951. ICICI came in 1955, IDBI and UTI in 1964, and later NABARD, EXIM Bank, NHB, and SIDBI. Most recently, NaBFID was set up in 2021 to finance infrastructure. After independence, India's financial system had major gaps. Banks avoided long-term lending, capital markets suffered from speculation and malpractice, and managing agencies stayed away from risky ventures. DFIs were created to fill these gaps. The objectives of DFIs were ambitious: accelerate growth, promote industrialization, support SMEs, housing and infrastructure, and even foster entrepreneurship. They weren't just lenders, they acted as agents of development. DFIs can be grouped into four categories: development banks like IFCI and IDBI, specialized institutions like EXIM Bank and NABARD, investment institutions like LIC and UTI, and state-level bodies such as SFCS and SIDCS. DFIs extended term loans for new projects, modernization, and expansion. They were funded by government equity, RBI schemes, and special bonds. With limited competition in debt markets, DFIs operated profitably while supporting industrial growth. By the late 1990s, the Narasimham Committee recommended DFIs evolve into banks. Liberalization allowed commercial banks into term finance. ICICI transformed into ICICI Bank in 2002, followed by IDBI in 2004, ushering in the era of universal banking. Voiceover script: IFCI, India's first DFI, was set up in 1948. It financed projects through loans and guarantees, and promoted institutions like MDI, ICRA, and NSE. Today, IFCI focuses on SMEs, IPO management, and advisory services. ICICI was established in 1955 with World Bank support. It began with project finance, later diversified, and promoted institutions like HDFC and CRISIL. In 2002, ICICI merged with ICICI Bank, becoming India's first universal bank. IDBI was set up in 1964 as an RBI subsidiary to act as an apex institution for industrial finance. It provided refinance, direct loans, and technical assistance. In 2004, IDBI transformed into IDBI Bank. In conclusion, DFIs filled critical gaps in India's financial system, driving industrialization, infrastructure, and SME growth. Post-liberalization, many transitioned into universal banks, but their legacy continues through specialized institutions and modern banks. This slide will give you clear understanding about various financial institutions and their established years along with their area of expertise and their current status. This will help in last-minute revision purpose for your exams. First up, IFCI, established in 1948. It was India's first DFI, focused on project finance and support for SMEs. Today, it operates as a mid-corporate specialist. Next, ICICI, born in 1955 to provide project finance and underwriting support. It evolved into a full-fledged bank and merged with ICICI Bank in 2002, becoming India's first universal bank. Then comes IDBI, set up in 1964 as an apex institution for industrial finance and refinance. It transitioned into IDBI Bank in 2004. NABARD, launched in 1981, focuses on agriculture and rural development. It remains the apex rural finance institution. EXIM Bank, established in 1982, is India's specialized trade finance institution, supporting export-import operations. NHB, created in 1988, is dedicated to housing finance. It acts both as a regulator and a refinancing agency. SIDBI, formed in 1989, is the apex institution for SME finance, supporting small industries across India. And finally, NaBFID, the newest entrant, set up in 2021. It's focused on financing India's infrastructure development. Question number 1. Which was the first development financial institution, DFI, established in India? A. SIDBI, B. ICICI, C. IFCI, D. IDBI. Answer: C. IFCI. Question number 2. Which committee recommended the transformation of DFIs into universal banks? A. Kelkar Committee, B. Rangarajan Committee, C. Narasimham Committee, 1998. D. Tarapur Committee. Answer: C. Narasimham Committee, 1998. Question number 3. Which of the following DFIs primarily focuses on agriculture and rural development? A. SIDBI, B. NABARD, C. EXIM Bank, D. NaBFID. Answer: B. NABARD. Question number 4. ICICI merged with ICICI Bank in which year to become India's first universal bank? A. 1994, B. 2004, C. 1999, D. 2002. Answer: D. 2002. Question number 5. Which of the following is not correctly matched with its focus area? A. EXIM Bank Export-Import Finance, B. LIC Agriculture Finance, C. NHB Housing Finance, D. SIDBI Small Industries. Answer: B. LIC Agriculture Finance. Question number 6. IDBI was originally set up as a subsidiary of which institution? A. IFCI, B. RBI, ICICI, D. NABARD. Answer: B. RBI. Question number 7. NaBFID, established in 2021, primarily focuses on A. Rural development, B. Export financing, C. Infrastructure financing, D. Housing finance. Answer: C. Infrastructure financing. Thanks for watching. Please subscribe for more upcoming videos.